So in the FA, in the textbook, it has two chapters, but I'm going to take it together. All right. So this chapter would be taken together as a whole, and then we'll do problems in the textbook. All right.
Mm-hmm.
Okay. So our next chapter, that is in the textbook, it is divided into two chapters. I'm just going to take it together. The chapter is consolidation. All right.
Mm-hmm.
Okay, and there are standards and numbers involved in this chapter, but I'm not going to go in in-depth knowledge of those standards and names because you don't need it in your exam, all right?
Mm-hmm.
Okay, just a moment. Okay, so what is a consolidation? See, suppose there is a company named P, all right? Okay,
Mm-hmm.
and there is a company named S, okay? So suppose P is buying S. P is buying S. So buying is called acquiring or acquisition. Understood?
Mm-hmm.
So P when acquiring S, suppose the P is buying more than 50 percentage of S's shares. Okay.
Mm-hmm.
Then there happens to be a control of P over the S, right?
Mm-hmm.
Okay, because it's literally the owner. Understood?
Mm-hmm.
So in this case, when you prepare FS, you need to prepare one more extra consolidated financial statements. Understood?
Mm-hmm.
Okay, so when you do that, you're going to bring together the SOPL of P and S, okay, and the SOFP of P and S. And these two things, when combined, is called as consolidation. Understood?
Oh. Mm-hmm.
Okay, now this S has a name and it is called a subsidiary. Clear?
Mm-hmm.
And the P has a name and it's called parent company. Understood?
Mm-hmm.
Now, here let's say the P has acquired 75 percentage of S. Clear?
Mm-hmm.
Then there is a 25 remaining, right?
Mm-hmm.
And that 25 is called NCI, that is non controlling interest. Understood?
Mm-hmm.
Okay, no?
Yeah.
So if they acquired 75 percentage, there is 25 percentage which is not in their hands. So that is called a non-controlling interest. Understood?
Mm-hmm.
Okay, now
Yeah.
non-controlling interest. Okay, the full form. Now, when you consolidate the SOPL and SOFP of these both companies, okay, then after consolidation, the parent and subsidiary company, that is the P and S, would be treated as a single entity. That means it's together a single firm. Okay. Now,
So SOPL and SOFP,
yes.
this report includes both companies,
Yep.
right?
Yep.
Parent and subsidiary.
Yep. But be aware that these people have their individual FS and also they have their group FS. That is the consolidation. Clear?
Mm-hmm.
Okay. Now we are going jumping into another situation. Okay. So situation is there is a parent company. Okay. P. All right. And P acquired another company named A. Okay. But when it acquired, it just acquired between 20 to 50 percentage shares. Okay. Or the 20 to 50 percentage portion of the A. Clear?
Mm-hmm.
Then we say it as a significant influence. That means P is able to significantly influence the decisions. P is not in control, but it can significantly influence. Clear, no?
Mm-hmm.
That is, it has the right to participate in the decision making process. That is, it can vote, can give its opinions, right? In
Mm-hmm.
this case, A is termed as an associate. Clear? And associate would always have a significant influence. Okay. Repeating again, if they have a more than 50 percentage share, then that is a subsidiary. And
Mm-hmm.
subsidiary, for the subsidiary, P has control over it. But if it is between 20 to 50 percentage shares, we say it as a significant influence. right? And it is called as an associate. Understood, no? Now,
50 like should be 49 or 50 included, like I mean 50.
50, within 50, 49. Clear?
Mm-hmm.
Okay. Now, so the rule is, in this case, there is no consolidation that happens, but we adopt a different method called as equity method, where you're going to take the cost of investment, that is how much ever amount that you had to pay in order to get that shares, plus all the profits that you incur in the year. Understood?
Mm-hmm.
So this is the method to which you calculate associate amount. Okay, no?
Mm-hmm.
Now, suppose there is a parent company P and it acquired I for less than 20 percentage, let's just say 15 percentage, then that is a simple investment. Understood? There is no control, there is no significant influence. Clear? Okay. So in this case, there is no consolidation that happens. You can't actually take the equity method. So you're going to adopt a different approach called as IFRS 9, which you would be studying in FR. All right. You don't need to study that here. Clear, no?
Mm-hmm.
Okay. Now, when it comes to consolidation, it is literally just five steps involved. Okay. If you study these five steps, you're clear. Understood?
Mm-hmm.
The five steps should be learned by heart. Clear, no?
Mm-hmm.
It's a must that you study these five steps by heart. Otherwise, you won't be able to answer consolidation questions. Clear?
Mm-hmm.
Okay. So the first step is the group structure. Okay. So in the question, they would be given details about how a company is acquiring the other, how much percentage it has acquired it with, right? And what was the
Mm-hmm.
date of acquisition, the month of acquisition. Okay. And the date of
Mm-hmm.
acquisition is called as a DOA. Clear?
Mm-hmm.
And DOR is the date of reporting. So you need to be aware of all these things. Date of acquisition is the date at which you have acquired the company, and it would be there in the question. Date of reporting is the year and date. Clear? And you also need to mention how much is the NCI. So in the question, they would be like P acquired as for 75 percentage, right? So remaining 25 is the NCI. So you need to fill in all of these things. Clear?
Mm-hmm.
Now, the
Mm-hmm.
second working is the net assets of the subsidiary. So, if it comes to net asset, that means the disposable, that is the asset that is remaining net of all the non-current liabilities, right? So, everything that the company owns. Okay.
Mm-hmm.
So, there is share in the net asset working, you're going to have two columns, DOA and DOR, date of acquisition and date of reporting. Clear?
Mm-hmm.
And you would be given in the question the share capital, that is you would be given an SOPL and SOFP of the both the companies, and you need to fill in the gaps. Clear?
Mm-hmm.
And you would take the share capital, the retained earnings, right? And the OCI, whatever that is there under the heading of the shareholders funds, you are going to take it off. Clear? Take it.
Mm-hmm.
Understood? No, whatever there is under the equity, you're going to take it. Okay. And
Mm-hmm.
sometimes it might happen that the land is revalued. So you're going to take the revalued amount on the DOA column. Clear?
Mm-hmm.
And if there is any additional depreciation, that is the fair valued amount would have additional depreciation. There you're going to take it into DOR column because depreciation is charged at the year end. Clear?
Mm-hmm.
If there is any asset that you have bought in the year, you're going to take it in both the columns. Clear?
Mm-hmm.
If there is the depreciation on the additional asset that has been acquired, you're going to take the depreciation on the DOR column. Clear?
Mm-hmm.
And lastly, it is the URP, which we are going to study in the later chapter or later portion of the chapter. Clear?
Mm-hmm.
Now, your first duty is to find the difference between the DOR amount and the DOA amount. Clear?
Mm-hmm.
And that is called as PAR, post acquisition retained earnings. Understood?
Mm-hmm.
Okay. So here what you do is you're going to split the PAR between the parent and the non-controlling interest. Clear, no?
Mm-hmm.
The third working is the goodwill. Okay. So goodwill,
Mm-hmm.
you're going to study two methods for it. One is proportionate share of goodwill on net assets and the other is fair value model of net assets. Clear? So
Mm-hmm.
under this is the thing that you're going to study. This is basically something that you study in FR. Clear, no?
Mm-hmm.
So in order to calculate goodwill, just know the logic this much. Suppose your business is worth is $5 million. Clear?
Mm-hmm.
When you calculated all the assets, it is just $5 million. Okay.
Mm-hmm.
But suppose your business is something that have been existing since 10 years. Okay.
Mm-hmm.
And it is very reputable business. So when you are going to sell it off, it is a very profitable business. So when you are going to sell it off, you're going to demand 8 million from them, right?
Mm-hmm.
So the extra 3 million comes from the fact that your business is making money, right? Your
Mm-hmm.
business is profitable. So that extra 3 million could be known as the goodwill. Understood?
It's like cost of business itself, yeah, on the market.
Yeah,
The profit you can
exactly.
get
The
if you
market
sell
value of the
something.
business. Yeah, exactly. Clear?
Mm-hmm. Yeah.
So, taking the same logic in the goodwill calculation, first you're going to take what you have given them. Clear? Fair value
Mm-hmm.
of purchase consideration. Purchase consideration as in what you give them for buying those shares. Clear, no? It could be with cash. Okay. It could be a deferred consideration. That means you tell them in the future, if it makes profit, you're going to give you this much of amount. Clear? It could be
Mm-hmm.
a share issue because you're going to give away a parent company share for the subsidiary share. Clear? It could be
Mm-hmm.
a loan note issue. It could be anything. So all the amount that you spent. Understood?
Mm-hmm.
And also you're going to add to it how much of the NCI is there. NCI as in the non-controlling interest. Clear, no?
Mm-hmm.
So when you take these two things together, you get the company as a whole, right?
Mm-hmm.
How much of the company is worth in the market when you take this together. That is the things that you buy and the things that belongs to the others. Fair value of NCI at DOA. Clear, no?
Mm-hmm.
From this, you're going to deduct the true value of the business. Clear? That is fair value of net asset of subsidiary. And this comes from working note 2. Clear? That is working note 2, this column. Understood?
Mm-hmm.
Okay. So the remaining amount that you get is called as a goodwill. If there is any fall in value of the goodwill, impairment is shown. And impairment is basically something that you don't have in FA. Clear? So I'm just gonna strike this off. Clear?
Mm-hmm. Mm-hmm.
Understood, no?
Mm-hmm.
Now, the next working is you need to find the NCI, that is the amount of NCI at the date of reporting, that is in the year end. So, you're going to take the amount of NCI when you acquired the business, that is fair value of NCI at DOA. You're going to add to it PAR from the working note 2, which you have split, and you're going to deduct impairment, if any. Impairment as in fall in value, it's not needed. Clear now?
Mm-hmm.
So when you calculate this, you get the NCI at DOR. Clear now?
Mm-hmm.
Now the last working, that is the fifth working for subsidiary, it is the group retained earnings. Clear now? That is you take the P and S group retained earnings together. For that, you're going to take the parent retained earnings. You're going to add to it the PAR calculated in group 2 for the parent. Okay. And
Mm-hmm.
impairment is something that you don't need. So I'm just going to cut it off. Okay. And then you need URP, which would be discussed later on. You need to deduct finance cost of any contingent liability, and this is also basically something that you don't need. Okay. And from
Mm-hmm.
there, you're going to add any profits in share of associate that you get from the next step. All right.
Mm-hmm.
Okay. And again, impairment is something that you don't need. Okay. So after this, you get group retained earnings. Okay. Now, there is an additional step on working note 6 if there is an associate acquisition. So if there is an associate that has been bought, you're going to take it into working note 6, which is also compulsory to learn. Okay, up until working note 5, it is subsidiary. For working note 6, it is associate. And for that, you're going to take the cost of investment. That means the purchase consideration that you have given in order to acquire that company, sorry, acquire that shares. And you're going to add to it the share in profit of the associate. Clear? And this is called the equity method. All right. And from
Mm-hmm.
that, you get the value of the associate. Clear? No?
Mm-hmm.
Now, the rules of consolidation, that is, if there is a more than 50 percentage acquisition, what are the rules? You need to add all the assets and liabilities together of each of the companies. Clear?
Mm-hmm.
Now, there can be intra-group transaction. That means a parent can sell things to subsidiary, a subsidiary can sell things to parents, right? So all those intra-group items would be removed and cancelled. Clear?
Mm-hmm.
Hello?
Yeah, yeah.
Okay.
Mm-hmm.
Third one, when you do consolidation, your POV, that is the point of view, is P is acquiring whole of S. Understood?
Mm-hmm.
And then later on, you're going to record NCI. That means you're going to mention separately what doesn't belong to P. Understood, no?
Mm.
Now, fourth one, at the date of acquisition, the consolidation is going to start. That means all the assets and liabilities should be added together. You need to find the goodwill. You need to find all those five workings. Clear, no?
Mm-hmm.
And after that, later on, you're going to prepare the consolidated FS. Okay.
Mm-hmm.
Okay. So the standard is basically that. Now we are going to dive into the chapters.
Mm-hmm.
First illustration. All right. I'm just gonna read out. I'm gonna read out the question. Listen carefully.
Mm-hmm.
Okay. In order to illustrate the basic principles involved in consolidated statement, the above is the question. Okay. So
Mm-hmm.
the question is as such, H owns all of the shares by S. Clear? And
Mm-hmm.
therefore, there is no non controlling interest to account for. Okay. And they have given you all the, all the details of SOFT. Okay. And here they have two columns, right? Just a moment. Hello.
Yeah.
So H owns all of the shares of S. So there is no NCI, right? Okay.
Mm-hmm.
And they have given you the SOFP of H and the S. Clear? And from here, you also know the year end, that is 31st December 2008. Okay.
Mm-hmm.
And around here at the last part, they have also given you 100 percentage holding in S, and the date of acquisition is 1st January 2008. Clear?
Mm-hmm.
Okay. And they have also given you the retained earnings at that date of S. Understood? From here,
Mm-hmm.
we're going to take in our first working. Clear? So in the first working, H has acquired S, right?
Mm-hmm.
Okay. H has acquired S, okay, and the acquisition percentage is 100 percentage. Clear? So if it
Mm-hmm.
is 100 percentage, NCI is 0 percentage. Okay. And
Mm-hmm.
what is the duration of acquisition? From the date of acquisition to the year end, it is 1 year. Clear?
Mm-hmm.
It happened in 1st January and the year end is 31st December
Mm-hmm.
2008. Clear, no?
Mm-hmm.
Okay. Now, the date of acquisition is 1st January 2008, which is also given in the question. Clear?
Mm-hmm.
And the date of reporting is 31st December 2008. So this is the first working. Clear? Now
Mm-hmm.
we are going to move on to the next working, that is net asset of subsidiary. Okay. For that, you're
Mm-hmm.
going to go to the equity section. That is this section. Clear? This section. Clear, no?
Mm-hmm.
equity section as in this one. Okay. And from there, you're going to take each and everything. That is the share capital, the share premium, and the retained earnings. Understood?
Mm-hmm.
So share capital, see, and in the heading, they say clearly it is net asset of subsidiary. So whatever you're going to take of subsidiary company. Understood? No?
Mm-hmm.
So 20,000 DOA and the same at DOR. Clear? 10,000 at
Mm.
DOA, 10,000 at DOR. Clear? And the retained
Mhm.
earnings DOA is over here. Understood? Okay, no? Hello?
Yeah, sorry.
So we have taken here. Okay? The retained earnings in the year of date of acquisition is here. So you have taken it here. Date of reporting DOR retained earnings we get from here. That is 25,000. Clear, no?
Mm-hmm.
You're going to total all these two columns together. Okay. And the difference is called as PAR, post acquisition retained earnings. Understood? No?
Mm-hmm.
Total of DOR minus DOA. Okay. And that is 10,000. For that 10,000, you're going to split it into parent and subsidiary. Here, it gets full of 10,000. Understood? Because it is a full acquisition. Okay, no?
Mm-hmm.
Now, the third working is that of goodwill. Okay. So for goodwill, you need the purchase consideration, right? How much you paid for the asset for all of the purchase. So here they haven't separately mentioned, but in HS SOFP, there is a line called investment that is shares in S, right?
Mm-hmm.
So that is what you paid for getting S. Understood?
Mm-hmm.
So purchase consideration is this one. Okay.
Just consideration. Mm-hmm.
And since there is no NCI, plus fair value of NCI is 0. Clear?
Mm-hmm.
Now you're going to deduct net asset of DOA. Net asset at DOA. All right. So for net asset at DOA, you're going to go to the working note 2 and you're going to take this. Clear?
Mm-hmm.
And the resulting figure that you get is called as goodwill at DOR. Understood? There is no impairment for your syllabus. Clear?
Mm-hmm. Mm-hmm.
So that is done. Now the next step is fair value of NCI. But in this case, it is a 100% acquisition, so there is no NCI. Understood?
Mm-hmm.
Next, working as group retained earnings. For that, you're going to take the parent retained earnings. That is here. It is clearly given 70,000. Understood?
Mm-hmm.
And for that, you're going to add the PAR. Clear? So for FA,
Mm-hmm.
it is very simple. Okay? You're going to add POR and the resulting figure is the group retained earnings. Understood? No?
Mm-hmm.
Okay.
Mm-hmm.
Now, when you take the consolidated SOFP, how you're going to take this? See, for NCA, non-current assets, you're going to add both of the assets together. See,
Mm-hmm.
for goodwill, you need goodwill as non-current asset, right?
Mm-hmm.
Because you gained goodwill and goodwill is an asset that you're going to get from working note 3. Clear?
Mm-hmm.
You must remember where it goes, right? Now, next is current asset. That also you're going to take it together. That is this plus this. Clear?
Mm-hmm.
You got total assets here. Understood? No?
Mm-hmm.
Now you're going to open the equity section. And in the equity section, you're going to take this share capital. Okay. That is of H. Remember, in the last line we studied, we prepare as if H acquired whole of S, right?
Mm-hmm.
So everything is prepared under H's point of view. So for FH, its share capital still remains at 65,000, share
Mm-hmm.
premium 35,000. But the retained earnings is something that you're going to take from working note 5. Clear? That is here. So see,
Mm-hmm.
Working notes are prepared for a reason. Clear, no?
Mm-hmm.
And normally you report the NCI here, but since the NCI it is zero. Clear? Since there is no percentage that is left over, the NCI is zero. Clear?
Mm-hmm.
Now you're going to add the current liabilities together. All right?
Mm-hmm.
Okay. And then you're going to add everything together. So if you've done things right, this and this is equal. In FA point of view, either you would be required to compute the working note, 5 workings, or they would be giving you a format of SOFP you need to fill in the amounts. Understood?
Mm-hmm.
That is how the question might come.
Mm-hmm.
Okay? Or else they could ask you in the MCQs of any workings from the 6 workings, including the associate workings. Clear, no?
Mm-hmm.
Okay. Now we are moving on to illustration 2. You need to do this on your own after the recording is uploaded. Clear?
Mm-hmm.
Okay, let's see. So, yeah. Mm, Here, they have given you D acquired 80 percentage of J on 1st January 2008. At the time of acquisition, the retained earnings of J is 20,000, which is required for working note 2. Clear? And they have
Mm-hmm.
also given you the fair value of non-controlling interest at the date of acquisition. That is for working note 3. Understood?
Mm-hmm.
See, I know the workings because I teach the workings, right? For you, you have
Mm-hmm.
to study it by heart and then do the problems. Clear?
Yeah.
Okay? And I'm just telling you where to look so that you get everything. Clear now? Now,
Mm-hmm.
the year end is 31st December 2008. So from that, we are going to prepare our structure. So the structure is D is acquiring J. There is an 80%
Mm-hmm.
acquisition. The date of acquisition is 1st January 2008. Date of reporting is 31st December 2008. It is a 1 year acquisition. Okay. And
Mm-hmm.
also the NCI. NCI is how much?
20%.
NCI is equal to 20 percentage. Clear now? This much is
Mm-hmm.
required. Now we are going to move on to the net asset of subsidiary. That is the second working. Okay. And for that, you need 2 columns, DOA and DOR. Clear now?
Mm-hmm.
Okay. So you're going to take the share capital of J. Okay. So 20,000 taken, 10,000 taken for both of the years. Clear now?
Mm-hmm.
So this much is done. Now you need the retained earnings. Retained earnings is over here. Clear? So it is taken here. Understood? Now,
Mm-hmm.
the DOR retained earnings is, however, here on the SOFP. Clear? So that is 25,000. Now you're going to total these 2 columns and the difference would be called as the PAR, that is the 5,000. Clear? Now,
Mm-hmm.
your net duty is to split the 5,000 between the parent and the subsidiary. Clear? No? Sorry, parent and the NCI. Clear? No?
Mm-hmm.
Understood?
Yeah.
Okay. So NCI gets 20 percentage and parent gets 80 percentage. Clear?
Mm-hmm.
Understood? See, you have got the workings. Okay. And this parent amount is taken into working note 5. Okay. And the NCI is taken into working note 4. Sorry. Clear?
Mm-hmm.
And both are to be taken where in the SOFP. Clear? No?
Mm-hmm.
Understood?
Mm-hmm.
You need to study the steps, then only you can do the problems. Now, the working note 3 is goodwill. Okay. So you need the purchase consideration. Have they given you a separate purchase consideration? No. So you're going to look into any investment made in J. Clear? No?
Mm-hmm.
Understood? So that is
Yeah.
60,000. Clear?
Mm-hmm. Mm-hmm.
Okay. Now you need to add the fair value of NCI DOA. Clear? and that is clearly given here. Understood?
Mm-hmm.
Now you need to deduct fair value of net asset at DOA, that is in the working note here, that is 50,000. Clear now? Understood? It's a lot to take in. All right.
Mm-hmm.
So 50,000 is taken here. And when you add all of these together, you get the goodwill at DOA. Understood? Clear?
Mm-hmm.
Now, the fourth working, NCI at DOR. So you take the NCI at DOA that is given in the question here. Okay. And unto that, you're going to add the PAR that you have calculated in working note 2 here. See? Okay.
Mm-hmm.
And then what you get is, sorry, when what you get the total is the NCI at DOR. Clear?
Mm-hmm.
Understood? No? Now,
Mm-hmm.
the fifth working is, see, when you look into it, all the workings are interrelated. See? Clear?
Mm-hmm.
Now you need the group retained earnings. So for that, you're going to take the parent retained earnings, that is this one. Okay.
Mm-hmm.
And you're going to add PAR that you have calculated in working note 2. Understood?
Mm-hmm.
That is here.
Mm-hmm.
Okay. Clear now?
Mm-hmm.
So your fifth working is also over. Now you're going to open the consolidated SOFP at 31st December 2008. Understood?
Mm-hmm.
You're going to take net non-current assets, add both of them together. Clear?
Mm-hmm.
And goodwill comes from working note 3. Understood?
Mm-hmm.
And then current asset also same thing. You're going to add both of them together. Okay? Now
Mm-hmm.
what you get is the total assets. Understood?
Mm-hmm.
After that, equity, you're going to take the parent's equity, 65,000 and 35,000. Okay? As for retained earnings, you're going to take working note 5. Clear? This one.
Mm-hmm.
Okay. And also the line extra is NCI that you have calculated in working note 4. Understood?
Mm-hmm.
And then you're going to add the current liabilities that is given here. You're going to add both together and find the value and it gets tallied. See? Clear now? So
Mm-hmm.
usually what I do is I take the workings and let a day off for the students so that they study the workings and then I resume the classes. Clear? But since there is
Mm-hmm.
a limited time issue, I'm gonna take it together. That's all. Clear, no?
Mm-hmm. Yeah.
Okay. So we are going to directly jump into illustration 7. Okay. So in the illustration 7, it's a different company, right?
Mm-hmm.
Illustration 7 is asking you what? Calculate fair value of net asset of peppermint. That is the number 2 workings. Clear, no?
Mm-hmm.
So for that, what you do is you don't need all the steps because in the question it is clearly given what you have to find. Okay.
Mm-hmm.
So you're going to take all of these things together. That is 400, 400, 400. Clear? 400, 400, 100, 100. Then the retained earnings would be there in the question somewhere here. Um, had retained earnings of 125,000. Clear?
Mm-hmm.
Okay. Now, in the balance sheet, the DOR retained earnings is 300. So we have taken it here. Understood?
Mm-hmm.
Now, the problem is they have told you there is a revaluation surplus. So that means it is a revaluation gain, fair value gain, right?
Mm-hmm.
So you're going to take that here as well. Okay?
Mm-hmm.
Clear now?
Mm-hmm.
They've clearly told you there is an increase in revaluation surplus. Understood?
Mm-hmm.
Okay, no?
Yeah.
Okay. So you're going to take the revaluation fair value gain that has happened in DOR has happened in DOA as well. Clear?
Mm-hmm.
And then you're going to total both of the columns together. Okay.
Mm-hmm.
And the difference is 175, which is PAR. Okay. And you're going to
Mm-hmm.
split it between the parent and NCI. Okay. And you're going to take it into later on, later workings. Clear? No?
Mm-hmm.
Now, I'm just going to take this and stop the class. Is it okay?
Mm-hmm. Yeah.
We'll continue tomorrow then
Yeah.
because I need you
But
to be up to date with everything as well. So,
yes.
next topic is intra-group trading. Okay. Next topic is intra-group trading. Right.
Mm-hmm.
So, what is intra-group trading? So, intra-group trading happens when you are actually doing business with your own subsidiary or parent. Understood?
Mm-hmm.
Okay. So any transaction that happens between the parent and the subsidiary is called as an intra-group tradings. It could be a receivable payable transaction. It could be some goods that is being exchanged. It could be the dividends that you pay out, right?
Mm-hmm.
Or it could be the profits on the unsold inventory, etc. Clear?
Mm-hmm.
Okay. So what happens? So when there is intra-group trading, you need to cancel things off. That's the rule. Okay. So there can be a receivable that is due, a payable that is due between each other, right?
Mm-hmm.
That would be there given in the question. A credit balance is due to the this company subsidiary. Clear? So what you do is you take them off from current asset and current liability. That's all. Clear?
Mm-hmm.
Understood? Simple thing. Okay, no?
Mm-hmm.
Okay. So illustration 8. So in order to see the acquisition, you're going to move on to the last part of the question. Here they have said P acquired 75% of S July 2005. The retained earnings at that time is 1150. Just a moment.
Mm-hmm.
Okay. So retained earnings is that much, and they have paid 3500 for investment in share of S. So purchase consideration is separately given. Clear? So let's
Mm-hmm.
fill in. So P acquired S. P acquired S 75 percentage. DOA is 1st July 2005. DOR is 30th June 2008. That is given here. Clear?
Mm-hmm.
And when you look into it, it is a 3 years acquisition, right?
Mm-hmm.
And NCI is how much would it be if it is 75 percentage? It would be 25 percentage. Clear?
Mm-hmm.
Now the second working net asset of subsidiary. So for that, you need this one for DOR, right? For DOA, it is given here. Clear, no?
Mm-hmm.
Understood?
Mm-hmm.
Okay. After that, there is an additional thing that is there in the question. That is, they have told you the land had a carrying value of 2500 and a fair value of 37,550. Okay. So
Mm-hmm.
that means there is a revaluation gain, right?
Mm-hmm.
So you're going to mention that both of the columns. Understood? Sorry,
Mm-hmm.
here. Okay. And they have also said that there is a fair value which is in excess of 500 on plant. Clear? So land
Mm-hmm.
has fair value gain and plant also have fair value gain. So you're going to take that both on the both columns. Clear?
Mm-hmm.
Now you're going to total things together. Okay. And you're going to find the PAR 2000. Clear? And you're going
Mm-hmm.
to split it 2000 into 75 percentage, right?
Mm-hmm.
And 2000 into 25 percentage. Understood?
Mm-hmm. The 2000, how you found PAR
This
2000?
one, DOR minus DOA.
Oh, okay. Mm-hmm.
Clear? Don't forget that. Okay? DOR,
Mm-hmm.
DOR minus DOA. Clear, no?
Mm-hmm.
Understood?
Mm-hmm.
Now, now. So, only difference that you get from this particular question is that they have given you an amount, right? Here, they've given you at the reporting date, P recorded a payable of 400. Okay?
Mm-hmm.
That is, P had to pay an amount of 400 to S. Clear? What I'm saying?
Mm-hmm.
So, that is an intragroup transaction, right?
Mm-hmm.
Okay, that means P had to pay S. So,
Mm-hmm.
for P, it is current liability. See ya? Clear?
Mm-hmm. Yeah.
For
400.
S, it is current asset.
Receivable.
Current asset, right?
Mm-hmm.
So, everything is the same. Until now, we have done three problems, right? So everything is the same. Only difference is that you have to remove this 400 from P's current asset, sorry, current liability, okay,
Mm-hmm.
and S's current assets. Understood? Only that difference is there. Every rest of the things, same thing that we have discussed just now. Clear? You're going to, as a homework, you're going to prepare till 5 workings. You're going to prepare the SOFP and SOPL. Clear, no?
Mm-hmm.
And when you do, make sure that you increase the value of the land as well as you increase the value of plant. Clear?
Mm-hmm.
Okay.
Mm-hmm.
Now, the illustration 9, that is test TYU 3 is that homework that I have just told you to do. Clear? Completely. Okay. Now, there is one more topic left, two more topics left, unrealized profits, which would be taken tomorrow. All right.
Mm-hmm.
Same
Yeah,
time.
but
Okay.
mm-hmm.
See, we are done. We are basically almost there. Clear? I don't want
Mm-hmm.
to overfeed your lessons. That's why.
Yeah.